Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're welcoming to the podcast Jessica Lee. Jessica is the Chief Investment Officer for Real Estate Credit at Manulife Investment Management. Jessica, welcome to the Compound Insights podcast. It's a pleasure to have you join us today.
Thank you. Appreciate you all having me today.
Jessica, how has your investment philosophy evolved over time, and what are some of the key experiences that have shaped it?
Sure. I have well over 20 years of investing experience, all in commercial real estate. Started my career really early days, investing on the real estate equity side. And pre-GFC and through the GFC, I essentially have more so focused solely on real estate credit. So just given sort of that early days exposure and the significant experience that I had alongside very senior investment folks through the great financial crisis. I think as a credit investor, the focus that you're always thinking about capital preservation is something that is very important to me, as well as any sort of credit investing that I've been doing for essentially through my entire career.
And anything about this cycle that we're in now that sort of feels fundamentally different? You mentioned the global financial crisis. Obviously, that's sort of extreme.
Yeah, I think that I agree. The GFC is probably an extreme, and unlike the GFC, we don't have really the issue with the capital crunch that we've had. And I think that a lot of fundamental sort of underwriting concerns have generally been less, more so rectified. And really, I think if we, and I'm sure we'll be talking about this, but as we look at the REITs today, it's certainly a significantly different rate environment than we had been in during the GFC. So I think it's very different, but the market does go through cycles. And we recently, a few years ago, coming out of COVID, obviously had the Ukraine war start, where it really capitulated the capital markets and had an impact. So, as I said, the market's fairly cyclical, and our job is to invest throughout, every cycle. And we're very excited with the tailwind that we have in the backdrop of the credit markets today.
What are you seeing as far as institutional demand? Has it evolved much or changed much in the last 2 or 3 years?
Yeah, I think that there's significant institutional demand because credit is a product, particularly real estate credit is a product that, from my perspective, combines the best of fixed income plus the fact that you have real asset collateral backing the loans. And while you may not get that equity-like upside return, you can certainly get consistent returns, consistent yield, and have that added downside protection whereby you're never the last dollar investor. And the fact that you can certainly build in bespoke loan structures depending on the investments that you're underwriting and originating.
Do you think that's always appreciated by investors, or are there other items that may be misconceptions or things that are not fully appreciated by
Yeah,
real
no,
estate
I do think
investors?
that the investors are certainly getting a lot more sophisticated, and investors definitely have a lot of other, direct lending or corporate credit exposure, and they're always looking for diversification and adding to sort of accrete their portfolio. And I think that real estate credit is a good fit. And what we think is interesting about real estate credit from the institutional investor demand perspective is that depending on the institutional investor, real estate credit can be bucketed to private credit in general, or real estate as a subcategory within those two sleeves. So it's the ability to be flexible from the investor's perspective, right? And the fact that you're always underwriting a real estate collateral makes it, I think, even more interesting.
And shifting to the macro, Jessica, how do you assess today's backdrop, interest rates, inflation, economic growth? What factors sort of matter most, and what do you think it looks like over the next 12 months or so?
Sure. So I don't know how long this recording is going to last, but I just want to remind all listeners that today is July 14th, 2026. We've had a lot of significant events occur where, for example, we have the new Fed chair, and I believe he actually said something like today that he basically will be tackling on inflation, which has been something he's been consistently saying, including his first official meeting as a Fed chair several weeks ago. So you have a very hawkish Fed as we stand here today. And it seems that based on everything that he has said and his actions thus far, he will not be as impacted by, the administration. So I think those are the two overarching factors. And based on those, our view is that really the rates, it'll probably be hard to justify rate cuts going forward. And I think that there's a lot of views on will the Fed be increasing rates going forward or keep them steady. And I think it'll essentially depend on how the inflation looks and of course the geopolitics that is about affecting gas and oil prices around the globe and how also of course the US in terms of employment and other industries get impacted. So all in all of this, from our perspective, the punchline is that the rate environment is very favorable to be a credit investor. And particularly in real estate credit, where our capitalization rates or cap rates, which is essentially equity multiple for those of you that are listening on the more with the corporate exposure, is that it's impacted by the 10-year US Treasury rate. And the 10-year US Treasury rate has been essentially hovering 4.5% for the last few years. And it'll be very hard to justify essentially a compression of cap rates, meaning asset prices. So that means as a real estate equity investor, you're not really relying on asset price increase, right? You're hoping for consistency in NOI and driving the NOI. So we think that that's a very good environment to be in for a real estate credit investor because from our perspective, we're definitely in for solidly for a higher for longer rate environment. And you're also in an environment where you are looking at real estate values that are essentially reset. And so you have the ability to lend at a much better basis, and also getting paid better than you would in other markets. And also things that I've said before, consistency in yield, and generating good risk-adjusted returns.
And you touched on the new Fed chairman. I'm just sort of wondering, is there anything you think the market as a whole or just some investors are underpricing in the macro, not fully reflecting it in their thinking?
I mean, I think it's very, very early. And so we'll see how this plays out in terms of, his hawkish stance as well as the inflation print that we'll see over the next few months.
And let's shift into themes, Jessica. What do you think will be some of the key themes in the real estate space over the next year or so?
Yeah, I think in terms of key themes, I'll touch on something that's been probably over sort of covered in our industry, which is the maturity wall. So this year, I think there's about, call it anywhere between 800 to 900 billion dollars worth of loans maturing this year. So the maturity wall, and of course, will extend and pretend to continue to happen. So that's certainly one of the themes. The second theme that we've touched on already is, the underlying very favorable rate environment. And then thirdly, I think it's really what property types, do lenders feel have the most headwinds versus tailwinds. So, I think that those are certainly some of the key themes that we're all thinking about.
And regional banks have been a player for a while in real estate lending. I'm just sort of wondering, where do you see them now? And overall, what does the competitive landscape look like on the lending side?
Yeah, so before I address your question on the regional banks, I just want to zoom out for a minute and basically set the sort of broad strokes framework. So for all the listeners, the U.S. real estate credit market is a $6.6 trillion addressable market. So if you just think about the depth and the breadth of the opportunity set, it is massive. And then if we break down the pie from that, the banks have generally been, call it anywhere between 40 to 50% of the market share. And of those banks, certainly the investment banks, the large GSIBs of the world, certainly have their greater share, given that they're very active, despite having had a lot of office exposure that we're all reading about or had been reading about in the press. The regional banks, and I think I'll sort of separate sort of some of the liquidity issues that they've had, but they've generally been more so focused on lending to what we probably would say, more local developers, borrowers, and on certainly on assets that are probably not as geared towards operational assets or more specialized assets. So I do think that they will continue to be active, but as a private credit lender, I think the competitive landscape or who we sort of compete with and the assets that we underwrite generally don't have much that significant of overlap beyond certain property types. And of course, I'm generalizing here, but I think how we think about regional banks, maybe even a year or 2 years ago with the liquidity crunch versus today's very different.
And back on themes, given what your outlook is right now and the trends you're seeing, what is your assessment of the overall key end markets, things like multifamily, industrial, retail, office?
Sure. I think that generally speaking, of course, and I'll start with multifamily, that's a sector where, depending on any research you read, the US has overall housing shortfall of anywhere between, 6 to 7, million units. And so that's a huge, essentially, shortfall in terms of the imbalance between supply and demand. And I think that given construction costs have been increasing, as we all know, due to inflation, and everything going on or had been going on with tariffs, the supply growth hasn't really kept up with the household formation and demand. So that's a sector that we like to spend time in, and we define, the housing sector, I would say, pretty broadly, given there's lots of different forms of housing, from student housing to age restricted and regular way multifamily housing and things like that. Industrial, I also think that it's somewhat similar, and I think in certain markets, it definitely similar to what multifamily has been overbuilt over the last few years, and some of those assets are having issues leasing. But then there's also specialty or more sort of thematic industrial or logistics asset types that we like to spend time in, and so I think it depends on, the asset type or sub-asset types within the industrial sector and on the markets. In terms of retail, it's one of those assets that I think it's similar to office in that it's haves and have-nots, and certainly necessity-based retail, whether it's a grocery anchored shopping center or needs-based retail, those have been more or less relatively stable and I think continue to do well, and certainly large class, A malls where, those assets certainly got securitized over and over again. And then there's obviously other selective opportunities and different types, but I think the most important from our perspective is, we always assess durable demand drivers, and we're also looking at the supply growth in the markets we're underwriting. And we're looking for assets where cash flows are sticky and can remain resilient. And our job as a credit investor is not to take any sort of, upside risk, right? And so we really focus on the downside risk of how every single deal that we're underwriting looks and shapes, and we go from there.
And with that outlook, are there any opportunities out there that you see that are, not as that are attractive to you, but may not be fully appreciated by the market?
No, I think that's a good question. I mean, I think I'll say office could be one of those sectors. I think it certainly has had its share of negative press, but I do think in certain markets where we're based in New York, certainly in Manhattan, the demand has been astounding in terms of driving rent growth, particularly in sort of these pockets within Midtown along, the Park Avenue corridor and even Hudson Yards. And those, I think, have generally been for Class A new sort of assets and or office assets where the owners have spent significant amount of capital investing into the office. And so I think this is one sort of pocket where it's done very well, and in other cities, it's still continuing to struggle because work from home has really never sort of, died down since COVID.
Even though the remote work aspect has sort of died down, I'm just wondering, there are areas, pockets where offices are being converted into residential properties. I'm wondering what you think of that trend. Is that sort of a niche market, basically?
Sure. I think that in the last week or so, the office to resi conversion happening on the Midtown East Side has been getting a lot of negative attention, given literally the building that is essentially blocked off, given a lot of potential negative effects from the conversion. So setting that aside, we at Manulife have a significantly high bar when it comes to any deal. And I think any office to resi conversion is an even higher threshold for us, given that office assets originally were never built to really be for a multifamily or any sort of a living situation. So, for example, floor plates. How do you take deep floor plate office buildings and convert that to multifamily, where every bedroom needs windows, right? And you need the right sort of plumbing and things like that. And so, we generally have a very, very high bar. Not to say we're not doing those, but we are underwriting and we're looking at those deals certainly. But it's something that we haven't done to date. And for everything that we do, we're looking at true risk adjusted, return. So for us, we will continue to evaluate those deals and continue to have a very high bar.
You touched on the New York market. I'm just wondering, geographically, are there areas areas of the country you find more attractive? And how do you approach geography? What kind of things do you look at when you go into a certain market?
Yeah, I think we just generally look at everything across the US in general. Certainly, I would say the coastal markets, from generally speaking, growth fundamentals are probably easier to explain than maybe markets that are not non-coastal markets. For us, there are certain markets where, for certain types of properties that we probably would stay away from. But that doesn't mean for other property types that those markets, don't look attractive. So it's a constant evaluation for us. So it really depends.
And moving into portfolio construction, how do you think about real estate's role overall? Is it a return driver, a diversifier, an inflation hedge, or is it really all three?
I think it's probably not necessarily a return driver, but I would say that certainly for certain institutional investors, depending on their benchmark, it has been able to replace, for example, real estate equity, depending on the credit return and risk selection that those investors are taking a look at. And certainly with the, some of the strategies where really you're deploying back leverage or structural leverage, you are able to generate equity-like returns for real estate credit, which I think brings a very interesting risk-adjusted return perspective to investors. I think yield is something that is certainly an easy explanation for everyone out there, just given that, for example, if we take a look at sort of, what Manulife generally focuses on the MIM side is short-term floating rates. So we essentially are, what we believe in a low spread but very high rate underlying market environment. So that to us essentially means, all of our loans are mostly pegged off of 30-day SOFR, and we generally have a SOFR floor, and then you have the spread. So essentially, given those things that I've outlined, the underlying investor has the protection of being able to rely on consistent demand, or sorry, consistent yield. So I think that's fairly important when it comes to real estate credit. And then I think that for us, it's a diversifier. And I also think most importantly, it's about capital preservation, right? And this is something I touched on at the beginning of the conversation, but In terms of real estate credit, because of the way that real estate credit works, and certainly short term, to your point, it's an inflation hedge, it's a diversifier, it provides relatively high cash and cash return, and certainly depends on the risk and the return that investors are looking for. And most importantly, it's also about capital preservation, which we think is fairly important. So for all of those reasons, it's a good diversifier.
If you were constructing a portfolio today, Jessica, what are some of the key metrics you focus on? Is it occupancy, rent growth?
Yeah, for us, I think it's all of the above. And because of the fact that most of what we do, at least for us, we're focused on direct originations and direct sourcing and structuring. And we're very focused on negotiations with our borrowers in terms of our underlying loan documents. And so our loan structures have bespoke, essentially stibs or covenants that are looking for everything that you've basically said, whether it's through debt yield and or debt service coverage ratios. We also have appraisal, LTV or loan to value steps, as covenants. We also put in other mechanisms such as, essentially in certain cases cash sweep, where essentially we trap all of the cash flows in as part of our collateral, and we administer the cash and we direct, along with the borrower, where all the cash goes, and according to the waterfall priority that we negotiate up front. And we certainly have provisions that, the borrowers would need to meet in order for us to be out of cash sweep or, uh, interest reserve replenishments and the like. And so we have a whole suite of covenants that we set, and our job isn't to essentially catch a borrower off guard. We're really trying to make sure that, we're aligned with the borrowers and we're as flexible as possible. That we also want to make sure that, the loans are structured well in case of essentially a situation that we could face down the road that no one wants to be in. And so really, number one, we think that it starts with a strong loan structure and collateral package that we're looking for as well.
And can you talk about, even though you do probably a tremendous amount of due diligence, once the credit is there, how you stress test over time? Is that a lot part of the equation here for things like economic or market shocks?
Yeah, I think that generally for us, we originate and we're lending on fairly high touch loans. So we generally have, for the most part, a natural touch point with our borrowers, at least once a month. And through that interaction, you're always assessing how this is performing relative to underwriting. What are some of the positives and negatives that's happening in the underlying market? Is the borrower working on a certain asset according to the underwriting projection, whether it's lease up or construction, and meeting sort of the timeline that we all thought and or agreed to in the underlying loan documents. And so I would say it's a constant stress test, and then on a quarterly basis, we have a much more formal process where we evaluate, similarly to our monthly process, every single loan on a more formal basis, and go through essentially discussing every credit internally. And that's also another good touch point for us because we're also trying to prevent, things from going sideways. And our view is that we should also be always looking forward to what could happen, right? Is there an impending initial maturity happening? What do we think happens with the asset? What do we think that the borrower wants? And so these are all the factors that go into the constant stress testing.
And for institutional investors considering or expanding their allocation to real estate credit, what characteristics should they look for in an investment manager, do you think?
Sure, I think it's a lot of really the basic blocking and tackling or fundamental things that you would want. One of the most important factors is, the alignment, right? As a GP, and two, it's also the fact that you hope to pick a manager where you're not a fair weathered real estate credit investor, and that you're in it for the long haul. So while that sounds pretty basic, I do think that that's fairly important. That you're a dedicated credit investor throughout market cycles. I think it's also important to be able to, as we did at Manulife, we built a purpose-built team and built the team organically, because we wanted to bring in individuals that can essentially hit the ground running and also be overseeing sort of the soup to nuts process of the entire loans life cycle from, sourcing, originations, underwriting, and structuring, and then of course asset management on the back end. And I think from all of our perspective, our compensation is really back-ended. So that's where the additional alignment works. And so there are a lot of factors, that comes to play. And I think for us, we try to be as thoughtful when it comes to, and when it came to how we built this team out.
And lastly, stepping back from all of this, what is the investment playbook, do you think, over the next 12 months for real estate credit?
Yep, I think that it's really a simple dynamic. I think the real estate financing needs will continue to remain significant. And for disciplined lenders, we think that that creates the ability to generate very attractive risk-adjusted returns with meaningful downside protection when it comes to, any loans that, the lenders are truly assessing risk and structure. And really in credit, I would say the goal is not to predict the future perfectly. It's really to structure investments so that the investors are protected even when the future doesn't unfold as expected. And as I said before, you have the benefit of a hard asset collateral.
Jessica, thank you for joining us today and sharing your perspective and terrific insights. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance.